Hi, Len Haderchuk here with the Financial Lens episode, Personal Finances in a Low Interest Rate Economy. If you have any involvement at all, any dealings with the economy, you have to know that we are in a terribly low interest rate environment. If you look at CD rates, the average one-year CD rate in the United States is 0.18%. The average rate of a 5-year CD is 0.32%. So let's put this in perspective. If you had $100 in a 1-year CD, you would expect to get about 18 cents a year, maybe about a penny and a half per month. If you had $10,000, you might get $18 in interest over the course of the year, which is really, really poor. The reason for that is because the U.S. Treasury is paying very low interest rates. The 2-year Treasury is only 0.16%, and the 10-year Treasury is only 1.67% compared to historic rates of about 3 to 4%. If we take the real returns, net of inflation, into account, we will have an expected return of about negative 1.5%, meaning when you have money in a CD, that's actually a very safe way to lose money slowly. So people ask me, Len, what are alternatives? Where can I put my assets so I can get some better returns? When we look at the investment landscape, there are 3 favorable features of investments that we would like to have in place. We would like to have investments that provide us with safety, liquidity, and returns. The problem is, there's nothing that gives you all 3. If you like the combination of safety and liquidity, you might be interested in a CD that will pay you less than 0.5%. A low return is the price of having a combination of safety and liquidity. If you want some better returns and are willing to take risk and are interested in the combination of liquidity and returns, you might be interested in a stock investment. Of course, they do not provide safety, but they may give you an expected return of around 5% in the next 10 years if you have a diversified portfolio of US and international stocks. If you're interested in the combination of safety and returns, you may be interested in an annuity. An annuity will be less liquid, but it will provide you higher returns than other safe investments like CDs and bonds, which may pay 2%. Annuities will have a potential return of maybe 3.5%. So when we look at the investment landscape, the returns compared to historic levels will all be at a lower rate than the future. If you're looking specifically at safe returns, annuities are actually a very good opportunity for many investors because we expect they'll get some better returns than other safe vehicles. Annuities have some bad misperceptions, they have some bad reputations. If you're interested to learn a little bit more about the annuity class of products and what are some of these myths and misperceptions about annuities, I would invite you to a resource that we will make available at the end of this program of Financial Lens. Let's take a little bigger perspective. What are people trying to accomplish with their assets? What are their objectives? And like I say, what is the disposition of those assets? How might people use those investments? Because when we think about it, money just sitting in an account doesn't really help you. It's what you do with it when you take it out of the account that really helps to improve your quality of life. If we look at a hypothetical pie chart of allocations, we have, of course, different investments we can be in. We could be in stocks, we can be in bonds, we can be in annuities, REITs, cash, we can be in different vehicles. But at the end of the day, what we're trying to do is we're trying to build our portfolio and have an investment allocation that will allow our portfolio to be worth more so that we could eventually get income from it, take periodic distributions. The difference between the two of them are income distributions are regular amounts on a regular basis, whereas periodic distributions are a little less frequent, a little less defined. We also may use our assets to pay for healthcare needs, particularly long-term care if we should have healthcare problems in our older years, and legacy. This means leaving money to heirs, our loved ones, when we pass away. When we have an asset allocation, we try to grow our assets given the amount of risk we are willing to take to build our portfolio to the greatest extent. But there's another way to look at how to handle finances, and I call that a disposition allocation. When we look at specific objectives we want our portfolio to accomplish and allocate our assets into vehicles that will provide us exactly what we want, not through a indirect growth strategy, but through a direct strategy where those vehicles are providing exactly what we're interested in. For example, if we're looking for income, we may be interested in an annuity product, specifically an income annuity. If we're interested in covering our healthcare costs for long-term care, we may be interested in investing directly in a long-term care insurance product. And if we're interested in providing a legacy for our loved ones, we may be interested in a life insurance product so that upon our passing, the assets that we want to leave to our heirs will get to them in a guaranteed fashion. So there you have it, two different approaches to get better results in a low interest rate economy. One, better returns in the growth strategy, meaning looking to replace less productive assets, specifically cash, CDs, and bonds with maybe an annuity allocation, and also looking at a disposition allocation strategy when we look at what we're trying to have our assets accomplish in a big picture and maybe bypassing the growth allocation, which may not get us the results we're looking for, and getting the results directly through financial instruments designed to efficiently provide that final objective we want for our money. Thanks for listening. Looking forward to hearing from you if we can be of assistance to you.